Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. Let's talk about an article here. It says Canada's subprime mortgage problem is growing as private loan use surges, right? So this is expected. More people are utilizing private loans because, hey, if you try to go to a traditional bank and you're trying to get a mortgage, they have so much stringent rules and requirements that you may not even get approved for the loan amount that you want, and or you may not be approved for a mortgage at all. Or if you've got a couple of properties and they see you as a big risk when they do their analysis, hey, they're also not going to give you a mortgage in that scenario as well. So a lot of people are utilizing private loans, and that's where you see this article here talk about that the private loan usage is growing. Now let's get into it. I'll link the article for you to read up more on this article, and I will go over and highlight the key points here. So the first paragraph here it says a Canadian regulator is sounding the alarms on private mortgages, but are they too late? The Financial Services Regulatory Authority of Ontario, FSRA, okay, so this is a regulatory agency that oversees mortgage brokers. They look at mortgage agents, and they are coming out and issuing a warning that, hey, they are warning the risks of private mortgages. Because why are they warning this is because they are seeing a huge boom in consumers utilizing these private loans. Now, what's the problem with private loans, right? Why is there such an issue? Isn't it just like a bank loan? No, the answer is because they are high interest loans. And often these loans are created in such a way that they mature very fast. So the renewals tend to be about, let's say, 1 year. And the worst part of it all is that the interest payments, that many of these loans may only be interest-only payments, and you're really just paying interest on these loans, high interest on these loans over and over again without even getting your principal down. So you're stuck with the debt and you're just paying free money out of your pocket just to hopefully and wait and anticipate that the home prices will rise. And this is a very big issue, right? We saw this, right? So why is this an issue? Why are people taking private loans, and why this could be an issue down the road? Listen, I totally agree with the concept that, hey, if you hold a home for 10, 15, 20, 50, 100 years, same thing with if you hold an investment portfolio and you invest wisely and you hold it for 50 years until retirement, sure, you will do well, right? You will do well, prices will go up. But here's the problem, right? We've lived with a decade-long interest rate environment where interest rates were low, right? We're used to that, right? We lived through the COVID pandemic as well, where during 2020, where markets crashed and did a very quick V-shaped reversal, and all the prices skyrocketed, especially in Canada. Housing prices doubled, right? If you bought a home that was worth $800K, you've doubled within a year. If you own a home that is $1 million, you made $2 million within a year. You own something that was $2 million or $4 million, you made $8 million, right? And it was all because of the money printing, the central bank coming out, Bank of Canada coming out and saving the markets by printing more money, by cutting and slashing rates to zero. And before that, we were used to of rates being near zero. So again, you're getting these investors, gamblers, whatever you want to call them, saying that, hey, rates can't be too high for too long. We're eventually going to get rates down, so let's just get this private loan, right? And yeah, rates are high, but doesn't mean that they're going to come down very quickly just like during COVID. Because this is definitely not COVID, right? COVID was a different era. And I'm not saying that rates can't come down. They will. When something breaks and something implodes, we will see rates come down very quickly. But if you look at the macroeconomics, and here's the issue, right? People are betting that this is the bottom. People are anticipating that things are going to turn around very quickly. Here's the issue, right? When you don't understand what's happening on a macro landscape, when you don't utilize history as reference when you look at 1970s and 80s, I understand history is not always a predictor of what the future will look like. But you can look at a lot of the macro data and you can look at the way the Fed has handled situations in the past and kind of guesstimate and estimate how things may look like and how and what the goal is for a lot of these central banks, which can then tell you what, decisions to make. Now, if the goal of the central bank is to bring inflation down, then guess what? History suggests that either you get a very ugly hard landing, crash, something that happens to bring inflation down now, or the Fed continues to hike rates even further, right? Or the central bank continues to tighten, or in this case, Bank of Canada continues to tighten, although they have paused. But let's say they go back and they continue to tighten aggressively or keep rates elevated for a year long, which they can, and keep the markets tight until something breaks, until the inflation comes down. And this is the problem, right? People are chasing, they're looking at the property markets. And as soon as there's a little bit of ease in the markets, like for example, mortgage rates come down because this whole bank crisis that's happening in the US with the regional banks causing yields to come down. And then now your mortgage rates have come down. And then all of a sudden you're saying, okay, guess what? We're going to get rocket boom prices in the real estate market and also in the equity market, and everything's going to be fine, right? All of a sudden, expecting the same thing what we got in 2020 may not be the case, and it may actually lead into a disaster, especially if you're not expecting, especially if you're betting that things are going to turn around very fast. And if you can't withstand and hold those payments for very long, or you're doing deals that require you to have a longer period before the renewal kicks in, then it can create a lot of troubles in the markets, and that's when you get the panic selling to kick in, and then the prices to really drop, and yes, inflation to drop as well. So let's get into a little bit more in this article. So it says traditionally these products are favored by those with poor credit, resembling subprime loans in the US during the 2000s, much like the US during that period. Canada's frothy home prices have attracted investors with solid credit, looking for more leverage than traditional lenders will provide. So, okay, even if you have good credit, doesn't matter. Doesn't matter if you're adding so much leverage and you're not hedging against it, then it doesn't matter what kind of credit you have. Just look at, for example, the US regional banks who were over levered and didn't hedge. They imploded, and you saw a lot of the share prices drop 60-70% in the matter of 1 to 2 days. So not everyone is prone to this. This is very, very dangerous. So scrolling down a little bit more, here's the big kicker, which worries me a lot. So it says here that since private lending is largely unregulated, there isn't a reporting body with a central data repo, right? So you don't even know how much or these private loans are out there because it's unregulated, which is sad. And that's a recipe for disaster, right? Leverage and being unregulated, those two together just creates a recipe of disaster, of just explosions and implosions, just like we saw in 2008. Just regulation was corrupt. The rating agencies in 2008 in the US were corrupt. People completely ignored it. People were going crazy with leverage. It was a euphoria moment, and then boom, and everything imploded. The real estate market imploded. So same thing here. Private lending, largely unregulated, and you're getting people still at it, going for more leverage. So it says information is scarce, but there is enough data to know the problem is getting out of control. Private mortgages represented no more than 5% of Ontario's loan originations until 2016. 2018, that number is now 7% in 2018 of a mortgage originations in the province were private. Now, what about today? What does that number look like today? So Greater Toronto's mini real estate bubble was the big contributor to this trend during that period. At the time, CIBC concluded investors used private loans for nearly 1 in 7, so about 16%, newly built condos in 2017. It was likely higher since the conclusion were based on accounts paying 9% or more interest. Crazy, right? So you're paying 10% interest, and hey, 2017, before that low interest rate environment, who cares? Property markets, prices are going up, you're going to make a fortune. And they were. Everybody was making a fortune. And then the overnight rate was also substantially lowered in 2017 than it is today. So you've got excessive more leverage. Now, fast forward to today, the Ontario Consumer Agency in charge of mortgage brokers has concerns. The FSRA looked at private mortgage originations and found explosive growth. The dollar volume increased 72% from 2019 to 22.4 billion in 2021. They estimate over 1 in 10, so about 10, the number has now gone to 10.6% of all Ontario mortgage originations in 2021 were private loans, doubling the share a half decade before. Okay, so we went from 5% of private loans out there in 2016 to now 10 to 11% of that in 2021. And 2021 was, I would say, the melt up, where really you had that explosive move in prices, doubling of home prices in 1 year, and then people going excessive leverage. And, you know, it was not only investors, it was common people. If you scroll down, it talks about an Uber driver who bought a $2 million home and bought it with leverage, and now is in trouble, is underwater with the prices coming down, right? You're hearing with people trying to close their condos, trying to close their houses, right? I went by a neighborhood recently, saw a lot of houses with lockbox on them, with houses half finished, not even finished. The builders have stopped, have told their workers to go home or laid them off because the environment, the economy is not looking good right now. And on top of that, you have people who can't pull up with the money, the down payment. So think about it. You go to a bank or you get a loan, or your bank or a loan agency company does an appraisal on the house, right? You promise you're going to give a down payment on a house that was 1.5 million. You've already set some money aside. Now you go back for appraisal. It's time to take delivery of your house, and you can't, or the condo, and you can't, because now the appraisal says your house is worth 1 million. So you got to put up, we're only going to give you 80%. So here's 800K, plus you're going to pay high interest payments on that 800K. Now you got to put up the 500 plus another 200. So you got to put up 700K out of pocket to buy that home, even though we're giving you less money. We appraise it 800 and you bought the deal from the builder for 1.5. So you're in a big loss, right? So this creates a lot of problems. So you don't have someone 700K out of pocket. So what do? You go to a private lender. And then you say, hey, can you give me 700K or part of 700K? And they'll say, sure, we'll pay you. You're going to pay another very high interest. So you're levered to the teeth, hoping things will turn around. And if they don't and prices continue to go down further, or if there's job losses, it could get very ugly. What most people are doing is they're simply just can't buy. And then that could lead to even lawsuits saying that you're supposed to buy this property, you're supposed to close. So we're going to take your deposit, keep that, plus on top of that, sue you for way more. Or the other scenario is maybe the builder will help and say, here, we will give you a loan, right? I'm hearing some rumors around there as well, but definitely not a good sign, right? So you want to be very careful. You want to be very educated what's going on, not over leveraging in this time. Be careful, right? History suggests, I keep saying it, history suggests to get inflation down, you need a break in the economy. It's not going to be coming down just like hocus pocus out of the air, right? You need something to break, and if nothing is breaking, guess what? Rates are going higher. And the Fed and the central banks around the world have said they will tighten and do anything to reach to their mandate to bring inflation lower. Said this over and over again. Finishing off with this paragraph here, it says that the narrative during the US subprime crisis was that people with poor credit defaulted. In reality, the biggest rise in delinquencies was observed with investors with multiple properties and credit scores that were prime or better. They just happened to be using subprime lenders since they needed more leverage and traditional lenders wouldn't provide it. Actual subprime borrowers that had been end users only saw a mild pickup from normal levels, which makes a lot of sense since living paycheck to paycheck and job insecurity isn't just something that happens during a recession for working class. It's just another Tuesday. So this article basically says, the last paragraph basically says that, hey, don't think that it was just people with poor credit. Yes, that was one part of the equation. Yes, they pushed that out in the media, but a lot of the delinquencies had to do with multiple properties, being over levered, right? Even though they had good credit scores, right? And utilizing these subprime lenders. So it doesn't matter how good your credit score is, right? If you over leveraging and you're playing with too much fire here, it could be dangerous. So be careful. So check it out. Check out the article. Let me know what you guys think. Leave a comment below. Subscribe. Hit the like button and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.